Welcome to UTI Mutual Fund presents Swatantra, powered by ET Now, an investor education initiative which essentially talks about how investing in mutual fund is perhaps the most preferred option for investors at large out there. It's also an attempt really to bring about investor awareness and educate investors on the benefits of investing in mutual funds. We have an esteemed panel here that will be discussing, giving out advice on how best to approach mutual fund investments at this stage. Let me just introduce the panel first. We have Mr. Iqbal Singh, Founder and Managing Director, Innovative Financial Management. We have Mr. Deepak Kumar Bhardwaj, who's an independent financial advisor as well. Shobhit Gupta, who is the Director of S&B Wealth Solutions. And Mr. Shashi Shekhar Jalana, who's also an independent financial advisor. Thanks very much, gentlemen. Mr. Singh, I'll start off with you. When you advise investors out there to make investments in mutual funds, what are the kind of preliminary assumptions that you work with?
First of all, when we talk about any investment in mutual fund, the most important thing, is the investor profile. Every individual is unique and their needs are different. So whenever you have to do an investment, we have to individually, assess your individual attributes in terms of what you want to invest, how much time period you want to invest, what kind of risk you would like to take, what are your various requirements and your goals. Based on each and every parameter as an individual, you have to do the assessment. And then based on your assessment, you have to do the asset allocation. And mutual fund is a vehicle to achieve your objective and the financial goal. So asset allocation is purely function of what kind of a risk you would like to take. So depending upon broadly, there are 5 asset categories. And through mutual fund route, you can invest through all those 5 asset categories, whether it's equity or debt or ETF or REITs. So there are different product or alternative investment. And secondly, there is a big myth or misnomer that this fund manager is not performing well, so my portfolio is not right. So your overall portfolio returns or financial objective and your goals is function of your asset allocation. It is not the function of mutual fund or a fund manager.
Shobhit, why mutual funds versus investing directly in the market?
What mostly I've realized in North India, what mostly we do is either a fixed deposit or a real estate. And probably 90% of the portfolio is inclined towards real estate. Not many people know this particular asset class called mutual fund, and we consider it as a risky thing. It is volatile, but not risky. You got to understand the difference between these two. And what we do wrong in investments in mutual fund, when we do investment, we check the value probably every day or every week. But if you buy a house, you don't check a value probably for 5 years or 10 years. So the discipline is very important. Asset allocation, the first important thing, profiling asset allocation, and then is the discipline. Market will be volatile, it will go up and down. But if you believe in India's story, if you believe India is growing, if you believe the companies you have invested in, the mutual fund has invested in will grow, people are buying more cars, the overall returns will be much better. So you have to maintain the discipline that market is volatile, you keep investing.
Mr. Bhardwaj, what is the kind of approach that you would give out to investors out there to ensure that they have enough exposure to all asset classes while investing in mutual funds?
Yeah, see, I strongly believe that the equity is the most important asset class because only equity has the power to beat the inflation, and our biggest challenge is to beat the inflation. So, but keeping this thing in mind, we also have to have certain kind of asset allocation depending upon the investor's risk profile and his capacity and the time horizon on his hand for the investment he wishes to make. Now, for typically, if anybody and everybody should have at least 30% of equity allocation in his portfolio, that is far most important. There's one more point which is very important, that you have to have some tactical allocation also. Suppose the equities are very low, means there is sentiments are very weak and the index has come to a very low level. That is the time you should increase your equity exposure. So there is no thumb rule in it, but you have to be a little dynamic. For that, you have to take the help of a financial advisor who can time and again can advise you and reset your allocation. That's why we need the portfolio review on a regular basis. So you need an expert who can actually help you during the journey of your financial investment.
Mr. Chilana, give our viewers and our audience members a sense of, if they decide to invest in mutual funds, what mutual funds should they choose to invest in? Because that's the top question that comes to mind, right? Which mutual fund is the best for me?
When you are investing in the mutual funds, you through diversified funds, you choose that first of all. Don't go for the sector specific funds. If you have not taken the risk, if you are informed investor, then go for the sector specific fund like IT funds, pharma funds, FMCG funds. In case you does not need, then go for diversified fund only. And asset allocation is a must be. You change with the life goal. According to age, you change your portfolio.
Just to add, there are two things which I want to add, at which you should use as a thumb rule. One is that whatever is your age, you should use that much as a debt, rest should be equity. Now then come to the selection of a fund. It is function of so many parameters, which you can always consult with your advisor. But predominantly, most important thing is the consistency of the fund you have to see. And secondly, the age of the fund. What is the age of the fund where you are investing? And how the fund manager is consistently delivering you the returns.
But what would be a simple mantra to go by with if, the understanding for financial ratios is not that deep to assess whether a mutual fund is a good investment option or not?
Generally, people are always scared about the markets. But I just want to share with you the history of the markets, or we talk about the Sensex, which started in 1979, 1980s from 100, and today we are 26,000. And if I'll just look at the compounding annualized growth rate, which is CAGR, which is around 16%, tax-free kind of a returns it has delivered. And we have seen so many ups and downs, and in fact, I have also seen so many cycles in this particular market. But most important parameter is you have to stick to the investment. That is the most important thing. And secondly, as you rightly pointed out, if you will not look at the ratios and detailed analysis, the most important thing you have to see the vintage of the fund. So the most important thing is the consistency. Second thing is that when it has started. And third, which is most important thing, is that you have to also stick to the person, or the fund manager who is associated with it.
Mutual funds always come with a disclaimer that past performance is not an indication of what the future performance would look like. What would you, advise investors out there to kind of focus on when they are choosing the mutual fund they want to invest in?
So as an investor, you don't have to pick up the best fund. There is no the best fund. It could be a best fund for 1 year or 3 months or 6 months. But look at a couple of things. One is which is a fund manager. He should have a track record. In every bull run, you have few fund managers who are good for a couple of years, then they fade away. So a fund manager with a 10 years, 15 years track record is something you can bet your life on, bet your money on. Second thing is the legacy of the fund. A new fund with a new theme, probably a good idea, but I'll give it a couple of years to perform and prove its mettle. But then something which has proved its mettle over last 5 years, 10 years, it might not be the best fund in last 1 year. But that's where the fund manager comes into play. He understands the risk better than you and me.
Mr. Bhardwaj, the other question that I often get is that where do I park my money, in select mutual funds? And then, most often than not, we advise investors to go through the systematic investment plan, the SIP route, because just putting in one chunk of your money and gaining exposure to perhaps a mutual fund is not the best way forward. What would you say to that?
Yeah. So there is an old saying that wealth may grow by leaps and bounds if it invested step by step. We all know that we have to save for our retirement, for our child marriage, their education, and several other desires and liability which life brings in. But the truth is that no matter how much we save, is never going to be enough, because inflation is going to take away if the return on your portfolio is lesser than the inflation. So the most important thing is that you have to find out the investment vehicle which can give you returns higher and more than the inflation. That's the important thing. If you have understood this thing, then half of your job is done. So what you have to do, you have to find an instrument which is nothing but equity. No other asset class has a power to outperform inflation on a long term.
But equities come with high risk, and as we've seen this year, have been very volatile. So then where does the argument build for a balanced fund?
According to SEBI guidelines, when you talk about balanced category, we are talking about you have to have a 65% equity and 35% debt. So, which will make it tax efficient as an instrument. Plus, at the same time, it is also giving you a margin of safety and protect you on a downside, like what we have seen in the last 1 year. Even in spite of a virtually zero return from the Nifty as well as from the Sensex, the balanced fund has delivered you a return ranging between 8 to 15%. So they have actually created an alpha to the tune of 8 to 10% over and above the indices. And at the same time, there are a lot of innovation happen in the balanced fund now, in the sense that if somebody's want a regular income from the balanced fund, they can take a regular income for their livelihood. Another innovation they have done in a balanced fund recently is that systematic withdrawal plan, where you want a specified amount which you want out of your total portfolio, you can get in the form of systematic withdrawal. And at the same time, it will also give you protection if you see that like market has not delivered you any return. Even in that case, balanced fund has given you tax-free return. And most important thing in a balanced fund is that whatever income you are getting on a monthly basis, it is in the form of a dividend. And there is no dividend distribution tax, which ultimately to the investor, whatever you are getting is, is deducted at source from your debt funds. Here, there is no dividend distribution tax on the dividend which you receive on a monthly basis from the balanced fund. So balanced fund is basically a good investment vehicle for the startup to experience, what kind of return you are getting from that particular product, and it is most tax efficient.
Shobit, for our audience members out here, the age range on an average would be between 25 to 40. If we take that age range, help them with their financial planning. Help them with a financial plan where they can benefit while investing through SIP into mutual funds.
So the thumb rule, what Iqbalji even said, is 100 minus your age should be in equity. So the younger you are, the more it should go into equity. As simple as that. And whether you are investing 10,000 rupees a month, whether you are investing a crore a month, it has to go via SIP. It not has to go lump sum. Lump sum is for traders, somebody who understands the market very well. For that, a lump sum investment is there. Two things I will again tell you. One is the discipline in investing. And the second is, we all forget the power of compounding. That is the one and the most important thing in any investment. And this is tax-free investment.
Just between the four of you, I want a quick sense on, at this point in time in the markets, what should one invest in, balanced funds or diversified funds? The choice is between the two.
I say in case your horizon is more than 5 years, then go for pure equity, diversified equity funds. If their horizon is 2 to 3 years, then go for balanced funds.
I don't advocate anything in mid-cap, multi-cap, balance. I would, at this particular point in time, strongly recommend to look at large cap fund if you can take a marginal risk, or if you don't want to take a marginal risk and large cap funds are available. If you don't want to take even a marginal risk, then buy index ETF at these levels.
So
balanced, diversified, index, take your pick.
So diversified equity funds with a time horizon 5 year and investment only through SIP. So next 1 year, 2 years, 5 years, it's going to be volatile. Not only India, international factors affect our stock markets a lot. What I believe is take an amount which you think you will save over the next 1 year, divide it around with 12 months, start investing, diversified equity funds.
Okay, Mr. Bhardwaj?
It is important to be in the right asset class, whether it is through balance fund or it is through a large cap diversified fund, that is okay. But of course, if you have a little higher horizon, more than 10 years, of course you should not be in the balance fund. You should be in the large cap 100% equity kind of a product. But yes, of course, if your horizon is less than 5 years, please do look at balance funds. But I'm a hardcore fan of equity, and if you have a horizon of more than 5-7 years, please invest in equity. That's the most important thing.
In case anybody has the lump sum amount right now to invest the money, you go for the ultra short term and by the way of the systematically transfer plan. STP is the best route to invest the money. From there, you weekly, monthly, you can invest in equity. Next 3 months, 6 months, 1 year, you can take it. The best route, that one is STP.
I just want to throw open the house for questions. If we have any questions from the audience.
What's the tax treatment for balanced fund?
Balanced fund is 65% equity, and as per SEBI, any fund which has 65% equity is under equity taxation, and after 1 year, 1 day, it becomes tax free.
Okay. We had another question.
Yes.
But sometimes happens in the market that he invest on your faith, on your advice. And you know recently one thing happened, that company's credit rating failed. How you protect the investor in such a category? Right? Investor doesn't know what is happening, what is not happening. People might be aware of that. So how you will guide the investor?
You know, you have to look at the portfolio. You know, you can, if you don't want to take any risk, and let me share with you, that is also not there in the hand of an advisor, you know, to control the portfolio or to influence the portfolio. So you can always look at as option of GSEC, which is purely sovereign, so you don't have the risk. But definitely you may get 0.5%, 1% lesser return than AAA rated corporate papers.
So you've been wanting to ask a question.
Recent trend has been that FIIs, which are savvy investors, are not putting in more of incremental money in the Indian markets, whereas general public through SIP is putting in huge amount of money, which means that this is basically a liquidity driven market. And as savvy investors are not seeing that much of value going forward. So are we not moving towards a stage where there is going to be a huge value bubble building, and it will ultimately have to crash if the performance does not live up to this? And the more the money which comes through SIPs will lead to that more of the froth or more of the bubble building up. So how do you look at this?
Yeah, why the FIs are pulling out money is for a different reason. It is not that they don't like India, because there was problem in China and then they had to underweight the BRICS as a whole. So they had to pull out money from India also. That's the reason. And once these things settle down, a lot of money is waiting aside, FIs money, they will be coming inside. But I tell you, whenever FIs are pulling money out of India, and that's the time, if Indians have invested, we have made a lot of money. In 2008, they pulled out money. Whoever invested at that point of time has made huge amount of money. So that's a very good signal that FIs are pulling out of money, and they're giving you opportunity to invest. They are giving you opportunity to invest at 25,000, 26,000. Had they not pulled out the money, you would have been investing at 30,000 happily, because markets have not gone down.
If I would like to add to this, why Indians are adding more? Why do you think you have started your SIP or you have started increasing your allocation into equity? Because all other asset classes have stopped giving return. So earlier, till last year and last 20 years were different for India. Well, real estate was giving much more return and everybody was comfortable with it. For last 3 years now, real estate is not giving return, gold is not giving return. FD and is going to eat into inflation. So what is left with it, you are experimenting with equity. What everybody smart investor has been doing for 20 years, you have started today. And it's good. We should make FII redundant. Even if they buy 5 billion or sell 5 billion, our domestic money should be enough to buy and sell it. But of course, when they sell in a sudden shift of the money, the markets will go down a little bit. That's an opportunity for you to invest. If they buy a lot of, suddenly you probably don't put your lump sum money, let the SIPs keep going in. So that this asset class is what Indian people have started understanding. We have miles to go. We are where probably US was probably 25, 30 years back. And India is India is probably not even 2% of the world index in terms of the total, the corpus, the money which is invested in mutual funds or the stock market worldwide. India gets 2%. So if they want to pull probably 0.5% across the world, India gets affected quite a bit. And there are a lot of other factors, US Treasury yields going up and all the other factors.
And sir, with the performance not coming from the companies and a huge gush of money coming through SIP, so my concern is the valuation bubble also.
No, why would companies not perform? If you believe that India will not perform, people will not buy houses and cars, don't invest. So it is a phase. So that's the irony. So everybody's pessimist today. You are pessimist today that markets are not performing, FIIs are withdrawing. That's what we are saying. When there is pessimism in the market, buy. That's the irony, exact irony, that today everybody is saying that it's not going to perform, FIIs are pulling out, the quarter results are the lowest ever been. This is the perfect time. Because once starts market going up, then you say you missed the bus.
Okay.
We have time for one more question.
My question is very basic. I want to know that by what minimum amount I can start investing in a mutual fund, and what is the ideal time period for maximum gain?
The minimum investment is 500 to 1000. You start with the 500 and 1000 also, sir. Ideal time period is you invest for 5 years. Minimum.
There are three things you should keep in mind. One is you should start early, invest regularly, and invest for long term. I think these are the three thumb rule which is more important rather than timing the market. You should be in the market but not do the timing in the market if you are routing through the SIP route.
No, the same thing is that at least start. No, don't worry about what's the minimum, maximum. It's as low as 500 rupees or 1000 rupees. So start. If you don't have an experience of equity, you can always say it's a risky product. Once you start doing that 500,000 rupees, you see it after a year. If you see, okay, 12,000 you have invested become 11 or 13. If it become 11, you let it go. Let it go for another year, 2 years. Once it comes into profit, then you realize the long-term gains of it. And if it is after a year, it's already 14,000, then you are encouraged to increase your SIP.
Mr. Bhardwaj?
Yeah, it actually doesn't matter. Suppose you want to start a SIP with as low as 500, and if your target is 1 crore rupees, so you have to probably invest that money for about 40 years. And if you want to achieve this same in 20 years, probably you have to do 10,000. So call is yours.
May I
That
just
too
add
with a
some...
nominal return of 12.5%. If it is 15%, you may end up earning 1 crore 50 lakhs or even more. That's the power of compounding. You know, the more time you give to your investment, more it is going to compound. So it doesn't matter. You have to take a call. How much time do you have got in your hand? Thank you.
Yeah, but I think what we all do is wrong. Like you are thinking what you should invest today. I think you should do a reverse calculation. From 30 years from today, you want to retire and have a couple of crore of a corpus so that it gives you about 40,000 rupees a month or 20,000 rupees a month. So if 30 years you need 2 crore rupees, do a reverse calculation at 12% conservative estimate. You need to start with 7,500 rupees a month probably. You don't have that, fine. Start with 5,000, start with 2,000, but increase as and when. And if you have something lump sum investment, do a bullet investment as and when the markets are down. But keep the goal into picture. If you are investing haphazardly, there is no point. You should have a goal. Even if it's buying a car after 5 years, have a final goal, you will reach this.
Sure. All right. On that note, I'll thank all the panel members for joining us today. Thanks very much, Mr. Bhardwaj.
Thank you so much.
Mr. Chilana, appreciate your time. Thanks to the audience members as well. You're a great audience, very informed. And we hope that this initiative has helped you in enhancing your own perspective with regards to investing in mutual funds. Just as a parting note, be part of this initiative. Do visit the website bswatantra.com. That's www.bswatantra.com. And you can follow us on Twitter as well. Hashtag Swatantra is the tag to follow. Thanks very much, everybody.
Brought to you by UTI Mutual Fund. हक एक बेहतर जिंदगी का.
Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.